We know that all valuations begin with understanding your gross revenue. However, all revenue is not equal. So today we're going to talk about the sources of revenue and how they impact your valuation. As a financial advisor or owner of a wealth management practice, you spend your career helping clients understand the value of the assets they own and how those assets can fund their needs and goals over the course of their life. Over years of successfully providing this expert guidance to a growing client base, the result is a flourishing business that's become a significant asset, if not the largest asset, that you own. Thus, understanding how this asset derives its value should be of high importance to you. So today we're going to talk and discuss about the first line item in a formal valuation process, the sources of your revenue, and specifically the differences between recurring revenue and non-recurring revenue and the impact that's going to have on your valuation. Now, as we describe the impact to your valuation from these two sources of income, please note we're not making any assertions about the suitability of the non-recurring revenue and products or investments you may use. So let's unpack the first component, recurring revenue. As the name indicates, recurring revenue is paid to you for ongoing services that your firm provides. It's not transactional in nature. Typically, it's derived from a percentage of assets managed by your firm for providing planning or investment advice to your clients. However, recurring revenue can also be generated from transactional products like brokerage and insurance products that pay a trail commission. For example, variable annuities wherein the advisor took a trail commission option, as well as some fixed and index annuities that also offer trailing commission options. This would include trails from life insurance, long-term care insurance, etc. All of these, because they have a trail or an ongoing recurring nature, they're going to receive recurring revenue treatment in your valuation. Financial planning fees could also receive recurring treatment if the fee is annual in nature. I do want to make a note that performance-based or other forms of incentive compensation will likely not be counted as revenue for purposes of the valuation since it's highly unpredictable. So now let's talk about the second form of revenue, non-recurring. Non-recurring revenue is essentially everything that's not recurring. Normally, it's associated with the sale of commission insurance products or other types of investment products that pay an upfront commission, such as a private REIT, for example. So that wraps up the definition of the two sources of revenue. So now let's talk about the impact to the valuation. The majority of valuations done by sophisticated buyers will be an EBITDA-based valuation. So let's revisit the pathway to determining EBITDA or net income. So the first step that we just covered is determining what your gross revenue is from all sources. We're going to subtract operating expenses. Operating expenses are all costs associated with the business with the exception of owner's compensation. So revenue minus operating expenses equals gross profits. We also call this earnings before owner's compensation, or EBOC is the acronym. Then we're going to reduce EBOC by retained owner's compensation, and that's going to produce net income or EBITDA. Now, when applying a multiple to EBITDA, the buyer will use your non-recurring revenue mix and apply that ratio to your EBITDA number. So for example, if you had 80% of your revenue from recurring sources and 20% from non-recurring sources, that same 80-20 ratio would be applied to your EBITDA. If the buyer were going to pay 8 times a multiple on your recurring revenue, then the non-recurring revenue portion would likely receive about half of that, or let's say 4 times for non-recurring. The note of importance is that the recurring revenue will receive a higher valuation multiple, if any, compared to your non-recurring revenue sources. So, and as I mentioned, most of the time it's roughly half. So following our above scenario, let's say that the selling firm with the 80-20 revenue mix had roughly $1 million in EBITDA or net income. If the buyer were to apply an 8x multiple to the recurring revenue, the non-recurring portion would likely receive roughly a 4x. So therefore, on the 80-20 blend applied to EBITDA, that would blend your multiple, that 8 and 4, down to an average of 7.2. Obviously, the greater amount of recurring revenue in your total revenue mix, the higher the valuation or the valuation multiple will be. The more non-recurring you have in it, the lower it will be. So in addition to the lower multiple on non-recurring revenue, you should also anticipate that whatever valuation is placed on that non-recurring revenue portion, the valuation proceeds will likely be placed in a retention payment or some type of earn-out scenario, meaning you have to produce that revenue for a period of time determined by the buyer before they will release the consideration for that non-recurring portion of your valuation. Buyers will be highly reluctant to pay for a non-recurring revenue source until after a period of time where that non-recurring revenue portion projected in the valuation was actually earned. So that's a quick primer on the differences in the sources of revenue and how they impact your valuation. I hope you found it helpful. I'm Alan Darby, CEO of Alaris Acquisitions. I'm looking forward to meeting you soon.